Dear students and viewers, you are most welcome to the third program of the Financial Management course. In the first program, I have discussed about the time value of money, where you have learned about the calculation of present value and future value of lump sum amount and annuity. With the concept of time value of money, you have learned to calculate the value of long term security in the second program. In this program, I am going to discuss on the topic risk and return from the lecture modules 8 and 9. I am going to focus on the topics like defining return and risk, using probability distribution to measure expected return and risk, coefficient of variation, attitude towards risk, risk and return in portfolio context, diversification of risk, and systematic and unsystematic risk. At first, let us know about return. Investors invest in securities for getting return. For example, if you buy any security and you hold the security for 1 year, then you can expect to receive some interest or dividend from the security, and at the end of 1 year, you may expect that the price of the security has been changed. Now, the sum of the interest or dividend you received and the change in price can be divided by the beginning price of the security, and in that way you can get the rate of return for that particular period. Let us see in the screen to know about the rate of return. The return from holding an investment over some period is simply any cash payments received due to ownership plus the change in market price divided by the beginning price. This particular formula can be used to calculate return, where dt is the cash payments received and this is the change in price, because pt is the ending price and pt minus 1 is the beginning price. So, the sum of dt plus pt minus 1 can be divided by the beginning price pt minus 1 to calculate return. For example, a security is bought for taka 100 and that pays dividend of taka 700 in cash and is owed taka 106 1 year later. From this example, we can put values in the equation. So, here dividend was 7, so dt is 7, ending price was 106 and beginning price was 100. So, this is the change in price and this is the beginning price. Now, by calculating this one, we get that the return is 13%. Here you get the idea about the formula to calculate 1 period return. The formula can be used to calculate the actual or realized 1 period return. That means, at the end of the year, when you know the actual amount of dividend and the actual change in price, by using these figures you can calculate the realized or actual 1 period return. But at the beginning of the period, when you do not know what will be the amount of dividend that you will receive in future or what will be the change in price after 1 year, in that case, by using the expected amount of dividend and expected change in price, you can calculate expected 1 period return. Anyway, it is simple to get the idea about return. However, it is little difficult to define risks. Let us consider a couple of examples here. If you buy a treasury bill or T bill that yield 8% and if you hold the bill for 1 year, then at the end of 1 year you will get 8% return, no more or no less, because the rate of return is guaranteed by the government. So, there is no variability in your return, but if you buy any common stock of any company, definitely you may expect the amount of dividend you will receive in future, and you may also expect that there will be a change in price of that common stock. But at the end of 1 year, you may find that the expected rate of dividend and the expected change in price may be difficult from the actual or realized amount of dividend and realized change in price. So, you find that here there is some sort of variability in the expected return and actual return. This variability is the risk. Risk can be defined as the variability of realized return from expected return. For example, T-bill would be a risk-free security, while the common stock would be a risky security. The greater the variability, the riskier the security is said to be. The variability of return can be measured by standard deviation, which can be calculated from probability distribution. You just learned that we can take the help of probability distribution to calculate expected return and associated standard deviation for any security. Probability distribution shows different probability for different returns for any security. Just consider this example here, measuring expected return and risk. Here you can see that there are possible return from any particular security where return may be minus 10% or minus 2% or 4% return, 9%, 14%, 20% or 28% return. And we can find the probability of each occurrence. That means, for minus 10% return, probability is 5%. Similarly, you get the probability for different types of returns here, and the summation of all probabilities will be 1. This is called probability distribution. For different returns, we get different probability. Now, to get the expected return, we have to multiply of each return with the respective probability. So, it will be minus 0.005, and similarly we can find all other results simply by multiplying possible returns and probability of occurrence, and the sum of this column will be the expected return from the security. In order to calculate the standard deviation of the returns, we have to follow this particular formula. That means, respective returns and the expected returns, we have to find the difference between these two, and we have to get the square value of this, and then the respective probability should be multiplied here. So, in the first case, you can see that the expected return was minus 10% and our expected return was 9%. So, here minus 10% minus expected return 9%, and we make the square of it, and the probability was 0.05. So, we have to multiply this one here. So, similarly, we can calculate all the figures here, and finally, by adding all these figures, we get the variance of the returns for this particular security. And you know that if we simply find the square root of variance, then we will get a standard deviation. So, the result 0.00703, we have to take the power 0.5 here to get the square root, and this is the standard deviation of return, which is 0.0838. You get the idea that the standard deviation of return can be used to measure the risks of any security. But when we are going to compare the risks of two securities which are different in size, in that case the use of standard deviation can be misleading. In that case, we can use the coefficient of variation. That is, we can get the coefficient of variation by dividing the standard deviation with the respective expected return. Let us see one example in the screen. Here we know about the use of coefficient of variance. Just consider these two investment here. You can find that in case of investment A, expected return is 8%, but in case of investment B, expected return is 24%. There is huge difference between the expected returns of two investments, but the standard deviation for investment A is 0.06 and for investment B is 0.08. So, if we simply look at the standard deviation of these two investments, we find that investment B is more risky as compared to the investment A. But if you simply compare this 0.06 against 0.08 and this 0.08 against 0.24, you can get the idea that this 0.06 is relatively more risky as compared to 0.08 against 0.24 or 24%. This is the problem of size. So, to adjust for the size or scale problem, the standard deviation can be divided by the expected return to compute the coefficient of variation. This coefficient of variation can be calculated by using this formula, that is the standard deviation divided by the respected expected return, that is R bar. Now, by using this formula we can calculate coefficient of variation for investment A and B here. You can see here that the standard deviation for investment A is 0.06 and expected return is 0.08. So, the CV or coefficient of variation is 0.75, and similarly for investment B the coefficient of variation is 0.33. So, it is very clear here that if we are going to compare the riskiness of two investments, then we should calculate coefficient of variation, and by calculating coefficient of variation we can say that investment A is more risky as compared to the investment B. Now, we can review the last example here, where coefficient of variation for investment A is 0.75 and for investment B is 0.33. So, we can say that the coefficient of variation is a measure of relative dispersion or risk, and the CV is a measure of risk per unit of expected return, because we are comparing the standard deviation against expected return. Then the larger the CV or coefficient of variation, the larger the relative risk of the investment, and the investment A with coefficient of variation of 0.75 is viewed as being more risky than investment B with coefficient of variation of 0.33. Therefore, for comparing the risks between securities, we can use the coefficient of variation, but different securities have different level of return and different level of risk. Now, the question is, what is the attitude of investors to the different level of risk? We can see one television game show here. In this television game, think there are two doors and you will get either taka 10,000 or a valueless used tire, that means taka 0, by opening any one door. So, this is very uncertain for you. So, you will either get taka 10,000 or get 0 by opening any one door. In most of the cases, it is observed that the certainty equivalent amount is lower than the expected value of the uncertain option. In the last example, maybe your certainty equivalent was taka 3000, but for other investors maybe it was taka 4000 or taka 5000 or even more than taka 5000. When we are comparing the expected return or expected value of the uncertain option and the certainty equivalent, we can get the idea about the attitudes toward risks for the investors. Let us see. In the second option, you can think of any amount x for which you will forget the above option if I will give you taka x or more in cash. So, in the second option basically it is certain because I am going to give you taka x in cash, but in the first option it is uncertain because if you open this door or this door, basically you have to take the risk either to get taka 10,000 or taka 0. So, in the first case, if we use the concept of probability, we find that the expected value of the first option is taka 10,000 into 0.50 and taka 0 into 0.50, because there is a 50% chance of getting money and 50% chance of getting no money. So, the expected value will be taka 5,000. Now, just think by yourself and decide what taka amount would make you indifferent between taking what is behind the door or taking the money, that is x. In this case, the amount you are thinking about to forget the first option, that is the uncertain option, is called certainty equivalent, let this certainty equivalent is taka x. That means, you want to forget first option if you get taka x instantly. Let the certainty equivalent for u is taka 3000. That means, if I give you taka 3000 now, you will forget the first option, but if you receive less than taka 3000, you will take the risk of the first option. For attitude towards risks, we can compare certainty equivalent and expected value. So, in case A, if certainty equivalent is less than expected value, we can say that risk aversion is present. That means, the investor is risk averse. In case B, if certainty equivalent is equal to expected value, we can say risk indifference is present. And in case C, if certainty equivalent is more than expected value, we can say that risk preference is present. That means, these investors like to take risk. However, the generally accepted view is that the most investors are risk averse. It implies that investors expect higher return for risky assets than less risky assets. In other words, you can expect lower return if the relative risk is low as compared to other investments. So far, I have discussed about the investment in one or single assets, but in most of the cases investors invest in different types of assets. When investors are investing in different types of assets, it is called portfolio. So, you want to know that what is the expected return for any portfolio. Now, we are going to discuss about the portfolio expected return. The expected return of a portfolio is simply a weighted average of the expected returns of the securities comprising that portfolio. The weights are equal to the proportion of the total funds invested in each security. Now, we can use this particular formula to calculate the portfolio return, where Wj is the weight or proportion of funds invested in security J, and R bar J is the expected return of security J, where J can be any number of security from 1 to m in the portfolio. Now, for example, there are two securities, security A and security B. If we want to make a portfolio of these two securities and making 50% investment in security A and 50% investment in security B, then we can calculate the expected return of the portfolio by using this formula, where for security A 0.50 is the weight for security A, it is coming from here, and 14% is the return for security A. Now, we have to add for another security, where 50% weight for security B and expected return for security B is 11.5. So, we can calculate the portfolio return, that will be 12.75%. You get the idea about the portfolio return. Now, before going to know about portfolio risks, you should have the idea about diversification. In case of diversification, basically we try to invest in different types of securities. It is generally said that do not put all of your eggs in one basket. It implies the diversification of risks. That means, spread your risks across a number of assets or investment. But simply by increasing the number of assets to diversify risks is not very sophisticated approach. Generally, if you invest in 10 securities which are almost similar, that means when the economy is good, all the securities returns are increasing, and when the economy is bad, all the securities returns are decreasing. In that case, if you invest in one security or those 10 securities, it will never reduce your risk. But if you find that there are some securities which are providing return in inverse way, that means when the economy is good, some securities are giving more return, but some securities are giving less return, and when the economy is bad, then those securities which are giving more return in the bad economy, that will give you lower return, and the securities which provided lower return when the economy was good, but when the economy is bad they are providing higher return. These type of securities are called negatively correlated securities. So, if you can make a portfolio by combining this type of assets where the returns are negatively correlated, that will reduce your risks, and this is called diversification. So, we get the idea that the diversification should be meaningful. Let us know about meaningful diversification. For example, this is the curve representing the expected return for security A, increase, decrease, increase, decrease and increase, and this is the curve showing the expected return for security B. So, if you compare these two returns, you can see that when the expected return is increasing for security A, at that time security B's return is decreasing. So, these are negatively correlated. So, we can make a good portfolio by combining these securities. In the combination of security A and B, we can simply overlap the expected return curves here. So, the expected return for the portfolio will be the average of these two, and it will be like this curve. So, you can see that the variability of return in the portfolio has been decreased as compared to the individual security B and security A. So, we can say that sum of each individual securities variability is offsetting, and benefit of diversification in reducing risk occur as long as the securities are not perfectly and not positively correlated. Now, we have learned that if we make a combination of securities where the returns are negatively correlated or not positively correlated, in that case you can reduce the risk. Now, the question is how much risk can be reduced in this way, and the second question is how many securities should be included in the portfolio to reduce that amount of risk. Here we get the idea about systematic risk and unsystematic risks. Some risks cannot be reduced even after increasing the number of securities in your portfolio. Let us know about that. The systematic and unsystematic risks can be defined by using a graph where in the horizontal axis we can see the number of securities in portfolio, and in the vertical axis we get the risks of the portfolio. Now, when we are increasing the number of securities in the portfolio, you can see here that the risks can be reduced, but at this stage actually the risk is reducing at a very lower rate. So, up to this level of risk it is not decreasing anymore by increasing the number of securities in the portfolio. Here you can see that this is the total risk for any portfolio, and this part is called systematic risk, which cannot be reduced by increasing the number of securities in the portfolio, and the upper part is the unsystematic risk. So, we can say that there are two types of risks, systematic and unsystematic, and you can see that total risk is the sum of systematic risks and unsystematic risks, where systematic risk is non-diversifiable or unavoidable, and unsystematic risk is diversifiable or avoidable. When you are taking more securities in the portfolio, you can reduce the risk, and basically you can diversify the unsystematic risk, and for increasing the number of securities in the portfolio, at last there will be some source of systematic risk, and you cannot eliminate this risk. Now, the question is how many securities should be there in the portfolio. Generally 15 to 20 securities randomly selected from the market can reduce the unsystematic risk, and only systematic risks will be there. Let us know more about the systematic risk. In the graph you can see the systematic risks, where systematic risk is arising from risk factors that affect the overall market, such as changes in the nation's economy, tax reform by the government, a change in the world energy situation, like this. Systematic risks consequently affect overall securities and cannot be diversified away. You get the idea about systematic risk. Now, what is about unsystematic risk? Unsystematic risks are generally related to the specific industry or business that can be eliminated by increasing the number of securities in the portfolio. Now, let us know more about unsystematic risk. In the graph, you can also see the unsystematic risks here, where the unsystematic risk is unique to a particular company or industry. It is independent of economic, political and other factors that affect all securities in a systematic manner. So, we can say that unsystematic risks can be reduced and even eliminated if diversification is efficient. Dear students, in today's discussion, I have already discussed about the risk and return and the use of probability distribution to determine expected return and standard deviation, and then we have talked about the coefficient of variation and portfolio risks and portfolio return, systematic risks and unsystematic risks. This particular topic is little complicated and also complex for many students because you have to use some sorts of mathematical models and formula. So, you have to practice a lot. Without practicing a lot, you cannot understand this topic. So, go back to your course materials, try to solve the problem that is given in your course materials, then you will be the master in this topic. Thank you very much and see you.